All right, so we are live. Obrigado. Obrigado. We're live. Let's begin. So today we have quite a ambitious schedule. We have Professor Veitsui talking about Chinese implementation and Pillar 2 aspects in China. And then we'll have Professor Martin Vance talking about implementation in Europe and implementation in highly developed countries. So Professor Tsui will connect at 6 p.m. and Professor Vance will connect at 7 p.m. So we have roughly an hour before all then connect, and we can talk about implementation in Brazil. And we are all familiar with the issues, and that's the reason why I didn't even make slides for this, because I really want to have a debate with you guys on what concerns do you think are our priority concerns about implementation in Brazil. We can discuss first if we did the right move, and if not, yes or no answers are not accepted here. If you think we did not make the right move, what are the risks that you see for Brazil implementing a QDMTT as soon as we did, both policy and you can go as far as legal risks and so on and so forth. And then we can go into the legal challenges the current QDMTT, current Brazilian QDMTT could face, the reasons why they did adopt it to the CSLL, if those reasons are grounded, and the worries that they said that they had are actually solved by using the CSLL. And then we can dive in a little discussion if Brazil should adopt an IRR. And I don't think we'll have time to go into a Brazilian UTPR. If we do, we can get into that too. If we don't, we surely can do that tomorrow when Ricardo is going to present the charging rules. We can go back to a possible Brazilian UTPR in the future. And it's a good discussion to have because Professor Tsui has a paper that's on the readings, which is very provocative, that challenges the mainstream reasoning for Pillar 2, which, well, you should adopt a QDMTT because the other people adopt an IRR or an TPR, and if you don't adopt a QDMTT, you're leaving money on the table. And he challenges that, and he also challenges the fact that adopting the IRR would be the way to go because it would curb harmful tax competition. The largest one by Professor Tsui. So the one that is not on Tax Notes International, the other one, and he'll probably get into that in his presentation, and we can do a warm up and discuss this a little bit. So I know that we have the microphone issue. I tried to bring a portable one, but the noise that it was making was impossible. So we still are bound to the microphone, but I want you guys to speak today. So please come forward, whoever wants to speak about the Brazilian QDMTT experience. Should we have adopted it? What are the pros? What are the cons? And then we can get into the legal grounds that this thing can be discussed and go from there. So who wants to start? I would hate to make this choice for you. So I'll start from left and front. If yeah, why not? Uh, Let me see if this one is a little bit better. Você pensa sobre nossa versão?
So I guess we had some thoughts on Pillar 2 from the last years. It was something that I always talked to Galendi about because he was so dedicated with the with the research and the doctorate, and I was thinking like this is such a big effort to something that it seemed to me, and I think to a lot of people, that it was very abstract, and it was very unlikely that we uh, would adopt such rules in such a short time. And even last year, we had a lot of uncertainty on the matter, because a lot of clients were asking, will this really happen? And we were very uncertain, and there was all the things about the U.S. elections and all the things that we're going through at the time, and with Receita Federal and all the stuff. And also because it happens kind of like shortly after the transfer pricing rules, that also was unexpected. So it was a very short time, but I think now we have a learn curve on the matter. And I guess from my professional experience, we are now looking a lot of the safe harbor issues and not the full calculation. So I think will be a lot of more problems and more questions on like the goodwill. I think it was sort of solved like in some way with the December legislation that altered the normative instruction, but I think we have a long way to go. And like Professor Schwery always said, that I don't want to translate his phrase because it's something like we have to enter the train, but not in the first seats. Like we should have taken the last seats. And it seems to me that it's been quite a ride with Pillar 2. And it seems like a very fast way to change a lot of things, and we don't have time to or think about the constitutional matters and all the things. So to me, this has been the experience. Although I think it's very interesting and the project and all the stuff that we have been researching, I'm like kind of scared because with QDMTT we just have a lot of issues for now, and now we're probably gonna have the IIR in the first semester. So I don't know, or and with the Trump stuff and the UTPR, yeah, I hope not. But there are a lot of rumors, and uh, it's just been really fast and challenging. So, in my opinion, like who am I? But I think it was very fast.
We've jumped the gun, in your opinion. We should have waited. Let's not forget that we are still catching up with transfer pricing, right? I mean, and it seems like it was long, long ago since our transfer pricing rules changed, but it was just yesterday, and we were still catching up with that. And then came QDMTT, and one can say that this is probably not the best way to update the law to do the whole thing at once, especially for tax administration, because they don't have that many people to spare with this bunch of new shenanigans at once, and not to have it already running the stuff that they change, and it'll take a while too. So yeah, as far as the moment, it's complicated to do it all at once. But we'll discuss the legal issues in a little bit. But as far as policy is concerned, I mean, the rationale, the mainstream rationale, and the rationale that surely the IRS has adopted in speeches and the government has adopted overall is that if we don't adopt the QDMTT, we're leaving money in the table for other countries to tax. So we either tax this and we update our effective tax rate to 15%, or we're leaving money on the table for other taxes with other countries who adopt the IR or even UTPRs to tax this remainder top up. So it's either them or us. Let this be us quoting. Otherwise, we are giving money for other countries to build schools and hospitals. That was the underlying rationale. And I see you not agreeing with that. So before I speak anything, please go ahead.
This is a subject that really bothers me a lot, um, because I've worked with tax law for almost 20 years, and I've never seen any client saying, "Well, I paid too little taxes in Brazil. I should pay more." It's not a low tax jurisdiction, Brazil, at all. And I think we gun jumped that, and we gun jumped in a bad way because it it was supposed to be, according to rules, something related to corporate income tax. Our lawmaker forgot that and called this thing as additional for CSL, for not sharing the revenue with other entities. This is a problem. Yeah, this is one of them, but that's the problem. And not only that, that was passed through a provisional measure that was converted into an ordinary legislation. In my view, this is not income tax, this is not social contribution, and it's something different. It's either a new tax or a completely different tax base that should be ruled, first of all, by means of a supplementary legislation, not ordinary law. Uh, Other than that, the basis for determining globe is based on the gross revenues. We have a tax on gross revenues, fiscal fins. Why shouldn't this should be taken into consideration for purposes of the 15% margin?
We'll get into the legal issues in a bit. I don't want to jump into that yet. So I'll come back to you with the legal issues. Um, Two things. The gross revenues, I might not agree with you on that one. I don't think the basis is gross revenues. I think it's financial accounting income, which is a pretty different basis than gross revenues. But we can get into that also when you go into the legal issues to say, oh, but that's a threshold. That's not the tax base. No, that's a threshold. A threshold is no, no, no. You're not taxing the threshold. The threshold is the gateway for you to be into or not the tax, but it's not a, no, but all right, we can get into that. We can get into that and the discrimination aspect of that, but that's another legal issues. But there's one thing that you talked about that we can get into now, which is we are not a low tax jurisdiction, and so there's no reason for us to impose that. Well, first, and I'll try to make the devil's advocate role here. First, if we don't have low ETR M&Es here, it would be only about adding a compliance burden, which is not to be taken lightly in any way because it's a huge compliance burden, both for taxpayers and tax authorities alike. So, if what you're saying is true, is that, well, in the end of the day, we're gonna go through all these hurdles to figure out that no top up tax is due anyway. But that's not what the numbers show. I have some of the numbers here. I don't know them by heart, but the IRS has already calculated that there is an X amount of the cover M&Es that would owe additional top-up taxes. And if you look even at the academic studies regarding ETR, they are very different, and ETR varies a lot between sectors. But you certainly have companies who have ETR lower than 15% in Brazil, especially the ones that are located in income tax incentivized regions, so lucro de exploração, those that use government grants and exclude them from taxable income, which may have in some years up until last ETR of zero at some point because they excluded the whole revenue and the exclusion might be higher than even their taxable income. You might have in education because of ProUni. You might have at hotels and alike industries because of Percy. You might have in M&A intensive industries who use M&A as a means even of R&D. So you have some commonly known book to text differences that may lead the ETR to a point lower than 15%. And I know that there's a person in the room who has defended a PhD thesis regarding Brazilian ETR. So I'll let that person speak.
No, it's not working. It's just until this. My opinion. Okay, let me start. I think the adoption was premature in Brazil, and considering like we are starting the adoption on the real life of the transfer pricing rules. Will be the first year that will send the information, the filings to the Receita Federal. We have different of the other countries. We have like e-financeira and all the filings that are so different. So I need to check it transaction by transaction. So and it will be like a very different methodology than we use it considering like the 9430. Yeah. So the second point is the CFC rules. Brazilian CFC rules are not CFC rules. Like they tax everybody, and like there is no like we this the CFC rules, Brazilian CFC rules. I think they get worse the trouble of the adoption of KMD TT. So because like for a Brazilian company that are the UPE, it's like a nightmare. For example, because like I already have like a company, and the most part of the situation, the top up tax will be triggered by the Brazilian profit, because I already I already take the international profits, and I will be taxed on 34%. And I work in an industry like financial industry. It will be like the worst moment for the industry to be the application, because we are this year in the adoption of the IFRS 9, that is the financial instrument. So we have like the all the credit losses as a DTA. We have like the Brazilian system, although even for financial companies, we have the temporary difference. So we cannot take the deduction of the losses that are under the provision. So we use it to be the financial system with the higher level of DTA of the world. Because of this, like the treasurer many years ago, because of the Basileia rules, but Basel rules for the measure of the risk of the financial companies, they issue a rule that if you have like a fiscal losses, and the bank start in having bankruptcy or some kind of credit crisis, the treasurer will be you can it's a kind of compensation of the DTA. And this was issued, this rules was issued because like we have the highest level of DTA of the road, and considering the Basel II, all the DTA based on credit losses are not considering as a capital. So we have like this is a nightmare for all the financial system. And this year we are like we could be happy, because like we are the tax rules change, and now we can take the deduction of the incurred losses that are a kind of provision. But
Like I have all the historic of DTA that I didn't take. So this year, the next year, I will take the deduction of the current losses and 185 of the source. So the tax rate here for the financial companies are lower than they used to be, although I have like a 40% tax rating. So, and when we talk about the corporate tax rate or the effective tax rate, the companies here, like a financial company, have a specific tax rate of CSLL, and this change a lot of things. So the most part of the companies we have like an controlled companies that are on a non-financial that we are taxed on 34, and like companies that are on presumido. So this make the calculation very difficult. The other point from the financial industry that is very difficult, like when we are taking the trading finance, basically oblige us have a branch offshore. So the most part of the companies we considering like the trigger of like the gross revenue. It's for a bank is not really corrected, because like we have a we should consider in spread, not just the revenue. So all the banks basically are on under are subject to Pillar 2, although they don't have like the banking profit or banking revenue reach the level of the Pillar 2. And everybody has one branch. So the question is, and it's worth have one branch that just they don't have like in the most part of the situation or operation. It's much more unvehicle to make to take money for to get to have money for a Brazilian company on trade finance, or to provide a trade finance company credit. So and this is like a worse too. So, and when we consider like the calculation, and the most part of the Brazilian bank are the UPA here in Brazil, when you just have one branch, like, and sometimes when I didn't reach the level of 15%, so I'm subject to the top up tax, is because of the Brazilian tax. So although so they use it to say that, oh no, we are taxing some amount in that it could be taxed on the other countries, but it's not very near to the reality of for the industry that I work. So I think it will have some specific points that it's not an correct address on my perspective, but we need to so in my perspective, this was like a premature adoption, and we will suffer the next years. And there is like a specific the JCP. It's another topic that is the banks are very known to be the payers, the biggest payers of JCP in Brazil. So it's an very, I think it's like a nightmare considering all the rules and the moment. Maybe in 2 years will not be so dramatic the situation, but this year I think we have some very big issues.
Thank you.
Michel is asking. Michel is asking for the
Yeah,
floor.
and I see Felipe has raised his hand too. Just a second before I pass the word to them. I think there are two issues that are really worth going into. The first one is the moment. Again, it's it's not without turmoil already. We didn't need to add anything else, especially to the financial sector, and a changing the accounting rules and a changing the deduction of the non-payments and how that affect your effective rate. And then, of course, the moment is definitely not the best. And yeah, as far as moment is concerned, I mean, 1+ year, I don't know if that made a difference. And 1+ year would have allowed for us to see what was going to happen in the US. And maybe after the whole Trump thing, if we're making the decision now, if we're pulling the trigger now, probably, I don't know, I don't want to speak for the government, but if I was there, I would probably have waited to see how will this play out. I mean, wait another year, it's not that big of a deal. The second thing is, and that is something that we really need to pay attention, is that whenever we draw the QDMTT, is well a foreign UPE with a low tax jurisdiction, constituent entity, and then its low tax jurisdiction will charge the plus whatever to get to the 15%, and then it will unplug the IRR in the UP jurisdiction. But the fact of the matter is that the adoption of the QDMTT in Brazil or in any country that wants to adopt a QDMTT also means that even though you have a Brazilian company fully controlled by Brazilian shareholders or public in the Brazilian stock exchange, the mere fact that this company has a foreign entity under them means that they are subject to the QDMTT here because it's an entity anyway. Even though it's the UPE and we don't have an IRR, the QDMTT catches it. And so it's basically a minimum tax on Brazilian multinationals. And it doesn't regard to the activity of the foreign subsidiaries because that is something else. It regards to the effective Brazilian tax on this Brazilian company, on its Brazilian profits, just for the fact that it is a Brazilian multinational. That it, in your case, because you have one MPE, but even in not your case, I mean, you're putting Brazilian multinationals in a different category than Brazilian non-multinationals. So it's not only about foreign investments in Brazil and the capacity of Brazil to attract foreign investments, which is something that need to be looked into when you adopt a QDMTT or not on a policy perspective, but it's also on the ability of Brazilian multinationals to compete. Not because the foreign profits are going to be taxed, the foreign profits are taxed, but under different rules, but because you're basically increasing the effective rate of these Brazilian companies on its local profits solely for the decision of this Brazilian multinational to be a multinational. So that is something that we need to take into consideration. And I have some other stuff that I want to get into, but I know that Michel has raised his hand and Felipe has raised his hand. I don't know who raised first. So let's start with Michel and then Felipe.
Hi, can you listen to me?
Yes.
So, just uh, taking a step back, you were saying that there are many reasons why the Brazil would have a lower ETR and tax grants and the federal losses and etc. etc. So, I think that the Brazilian Congress could be a little premature here approving the TMTT because we haven't assessed why the reasons why there are uh, the multinational with this lower ETRs, as it seems a little contradictory that we approve tax grants, we approve incentives, and then we say no, but we cannot use all of them. You need to at least pay a 15 minimum tax. But on the other end, from a Brazilian constitutional perspective, at least, we can be shifting taxes from states and municipalities to the union as we did it through an additional CSL and not through corporate income tax. So we give tax expenditures, we give tax incentives, and then we tax it just to the union through CSL. I think that's a probably probably an issue from a federalism perspective here. I don't know what you guys think about that as well.
All right, that is certainly an issue that we need to get into a little bit later when you go into the constitutional issues. But thank you, Michelle. I'll let Felipe speak first, and then we'll continue. Felipe.
Hi, good evening, everybody. Can you hear me? Okay. Well, let me just start by having a disclaimer. I'm not very familiar with the rules, the Brazilian rules and the Pillar 2 discussion, so I'm here to learn. But I have some points here. And before we go into the details of the Brazilian law and the timing, which I understand that was not perfect because of transfer pricing rules, and we didn't have enough time to think about it. But I want to move back and think about the policy behind it. Does it make sense for Brazil to implement KMDTT to tax, especially, well, I know that you mentioned, Gustavo, that it also applies to Brazilian multinationals that have subsidiaries abroad, but let's think about the case where foreign multinationals that have investment in Brazil. So Brazil as the source country. And we know that there are some situations, and you mentioned the field, in which the effective tax rate it's under 15%, although the nominal rate is 34%, which in case of Brazil, it's not a low tax jurisdiction, but there are situations in which companies pay less than 15% effective tax rate. So considering that situation, and in considering that Brazil is in a deficit situation, so it needs to raise money. It's always thinking about how to raise money. Is it an effective way to raise money? And because if it doesn't tax, as far as I understood, if it does not tax, and another country adopt the global minimum tax, then it will apply the top-up tax. So it seems to me that from a policy point of view, it makes sense for Brazil to adopt it. I'm not going to go into the detail if it was the right timing, if it was the right instrument by a provisional measure and using a social contribution for that. But it seems to me, well, again, from someone who's not very familiar with the rule, that it makes sense to use the PMDTT. When it comes to the other way around, perhaps it's not. I mean, if it's a Brazilian multinational investing abroad, perhaps it's not the best policy, but for foreign multinationals investing in Brazil, it seems that it's a good policy. So I just wanted to make these comments here, to see your opinion, if it makes sense.
Great. I'll comment on both, and then I'll pass the word to you. From a policy perspective, Michelle has raised the question if, well, Congress seems to be a little in a little paradox, because at the one hand it approves the incentives through the book to tax differences and low ETR drivers, and then it approves a minimum tax. That is not something new. I mean, the whole minimum tax thing comes from, I think the first experience is the alternative minimum tax in the US, at least the first that I know. And the alternative minimum tax is exactly that. We reach a conclusion that Congress is captured by a lot of lobbies' interests, and there are a lot of provisions in law who are either by lobby or by history that are there. They are book to tax differences, they are ETR drivers, and we cannot repeal each of them individually, and maybe we don't want to repeal each of them individually because they still have a place in the tax code. But if you look at them globally, you don't want to allow them to drive your effective rate lower than a certain point, and then you adopt a floor. That's what the alternative minimum tax did in the US for individuals, the corporate alternative minimum tax for corporations, and that's what the QDMTT does. So it may look as a contradictory policy, but one can say that it's just the opposite. It's a way to make the tax incentives survive and not have to be repealed, even in a world where every other country is policing your effective tax rate. So it's a way for you not to individually change your tax policy or repeal ProUni, repeal lucro de exploração, repeal each of the incentives that you still want to keep under law, but you establish a floor for ATR that at least for certain corporations will apply, the ones that will be policed by the rest of the world. So it's not necessarily contradictory. One might say that is the only way to allow for the incentives to survive on the new world is to accept that there will be a floor, an overall floor, and not an individual floor for each incentive. I'm not saying that I agree with this, but I'm saying that, well, certainly a case can be made. But then again, this takes into account a premise, which is the same premise that Felipe was working under, that, you know, there will be a war police. If we don't do it, somebody else will regarding our profits. So either through IRR or through UTPR. And that's the underlying assumption. That's the underlying normative assumption. And the OECD and the inclusive framework, for the matter of fact, they sold this very well. That we're looking into a scenario of full adoption. And even if we are not looking at a scenario of full adoption, at least adoption up to a certain threshold of countries will be enough for the system to withstand and for UTPR to apply and IRR to apply, and the world police will be there on a paternalistic manner, granting that the 15% will be kept alive. And that is a premise that at least Professor Tsui, which will speak in about 20 minutes, he challenges it. And he challenges it from an economic perspective just by asking, well, what each country as an income maximizer would do individually, because we're not looking at a multilateral treaty, we're not looking at diplomacy, we're looking at individual adoptions that, as far as we're concerned, each country looking at their own best interest will adopt the rules. And that's Felipe's rationale. I mean, we looking at our own best interest will adopt these rules, because if we don't, our profits are going to be taxed somewhere else. And so there will be an international income transfer from Brazil to any country that has an UTPR or an IRR, because these profits are not going to be taxed here, they're going to be taxed elsewhere. And they are within the same multinational group. So those profits are going to be taken out of the group. So it's going to be less income here. Either, when I say income, is either for the government or for the corporation. It doesn't matter, because taxation is just a transfer of income from the corporation to the government. So if it stays within the country, on the public sector, on the private sector, that's Professor Tsui reasoning. It doesn't matter. But if you take it out of the country, then it matters, because you're not maximizing the income from the country. So the assumption here is that if you're not taxing at least to 15%, somebody else will, and there will be an international income transfer. So that's what they sold us. That's the underlying reason for the QDMTT. But for that to be the reason for the QDMTT, an assumption must happen first, which is countries will adopt IRRs and UTPRs. Because if no country adopts IRRs and if no country adopts UTPRs, then there's absolutely no reason for you to adopt a QDMTT unless you want to raise tax revenues. But then you don't need a QDMTT. Then you just need to change your corporate tax. And you can do it in a lot of different manners. And the thing is, are we so sure that this will be the underlying rationale and this will be the norm from now on? Well, I don't know. The change of U.S. government, we'll see right now what's going to happen with China. I don't know. And Professor Tsui go as far as saying, well, you cannot assume that everybody will adopt an IRR. The same manner that you cannot assume that everybody will adopt a capital export neutrality norm, If that was the case, capital export neutrality would still be the norm from the 1990s up until today, and it's not. Because, if you look at the Kennedy proposal, full CFC taxation without any deferral of active income and passive income, that would mean that it doesn't matter what is the effective rate in the host country. What matters is what is the effective rate in the home country of the investor. And capital export neutrality has been abandoned. Well, you can say that it has been abandoned because it was never adopted in full, and deferral always allowed for tax incentives in the home country to thrive, and active income was never taxed at home, not even in the US. And certainly a case can be made for that, but there might be a reason for that. There might be a reason for those countries not having adopted full capital export neutrality. And well, the IRR is different. The IRR does tax active income promptly without deferral if the home country of the investment effective tax rate is lower than 15%. So those countries should adopt the IRR. Well, Professor Tsui comes and say they would, but for the QDMTT, because the fact that they adopt the IRR means that the next step will be for the home countries of the host countries of the investments to adopt the QDMTT, because as Felipe was saying, they will want to get that money. And then is the conundrum, because you would adopt the IRR to raise revenues from the top up between, let's say, the home country, the host country of the investor taxes 10%, you want to tax to 15, so you get this 5 extra. So you adopt an IRR as the, it's hard to divide the world as home and host countries, and that's a heroic assumption that can be challenged. But let's say that there are countries that are more home than host, and there are countries that are more host than home. So the home country of the investor adopts an IRR for that to get this 5 extra. But then, right after, the host country of the investment adopts a QDMTT, and those 5 goes to the QDMTT country. So the home country of the investor has adopted the IRR for absolutely nothing, because no money will go for that country. One can say, well, the IRR also avoids profit shifting. You might get something back from profit shifting. So, but you'll still be not getting those 5, or a big chunk of those 5 that will go to the QDMTT. And you're going to say, so what? You are not taxing those 5 anyway. Yeah, but those 5 were considered to be national income of your country because it was of a multinational that was there. So even if it was not being transferred to the government, it was still income that you attribute to the country. And if it's taxed by the host country of the investment, now you're losing that to that country. So it is an international transfer of income. But whereas in the other case, you were just not transferring to the government, but it was still on your balance of income. So it is relevant. And if that is the case, you should not adopt the IR. But if you don't adopt the IR, then there's no reason for the other country to adopt the QDMTT. So it's a conundrum. And well, then there's the UTPR. So if nobody adopts the IRR or nor the QDMTT, you still might have somebody adopting the UTPR. So there's always the bad policeman staying out of the room and promptly to beat you up. But also, that's a very heroic assumption to think that everybody will adopt a UTPR. First, because the UTPR certainly have very big legal concerns. And second, because also from an income maximizing perspective, there might not be always a good idea to adopt an UTPR, simply because the UTPR will be taxing the local business of the country that adopts the UTPR. And the UTPR might lead even to a negative income of that business, because you're disallowing deductions that you would allow in the first place, and you'll be taxing a profit that is not there. That is the big problem with the UTPR. And I'm not going to go into the legal issues, but as far as economically you're thinking, you might drive that business away with an UTPR. So will countries really go for that? So what I see is that the the whole thing was very well sold to the world by the OECD. It helped that it was under the Biden administration, who kind of signaled that they would adopt, but didn't do anything, especially because the Republicans in Congress didn't allow. And the OECD was uh, marketing effective enough to sell it to the European Union. And then you have the directive. And the directive is the real thing that is still keeping this thing together. If not for the directive, I would say, hey, come on. Brazil is really, really jumping the gun in adopting a QDMTT. But we do have the directive. We do have Europe. And that is not irrelevant. As Ruven was saying, it's not easy to repeal a directive. It's not easy to adopt one, and it's not easy to repeal one. So we are in this kind of a stalemate where there might be a critical minimum critical mass for the UTPR to work within Europe. But if it's just Europe, if the UTPR turns out to be just an European thing, and the IRR doesn't see the light of day either in the US or China, I would say that we're still probably looking at a failed attempt of a global minimum tax. And economically, it makes no sense for a country to adopt an QDMTT in this moment. But that's one view. Yeah, yes,
just consider that Japan is also in Europe and Japan.
Europe and Japan, yeah. Japan did jump into the UTPR bandwagon, right?
And recently, after the US
Yeah.
took its position.
I know. So, yeah.
Well, looking from a tax policy perspective, I think the main problem is the fact that the Pillar 2 requires us to be in line with many other instruments that we're not really completely aligned to. For example, we have the CFC regime, which is very different. We have just adopted the transfer pricing rules. We have a completely different treatment for PEs and their profit allocations. And we need to consider, for example, mutual agreement procedure to deal with these problems. We also don't adopt the arbitration clauses. So it's kind of hard for me to understand how it will work. And but I mean, I understand the whole concept of the race to the bottom problem. Oh, he's there. And the need to raise tax revenues. But at the end, I'm not really sure if we are achieving our goals from a tax policy perspective in Brazil.
Sure. Well, thank you. So let's, I see that Professor Tsui might have joined. Yeah. So let's see if we can begin here. Professor Tsui?
Hi, yes, I'm here.
Hello.
Can you hear me okay?
Perfectly. Hello, Wade.
Luis, hi.
I
Good to see
apologize for not being in person, but I had a surgery yesterday, so my
Oh,
nose
no.
is completely I don't know, but I mean, it was on my nose, so my face is with bandage and so on. So I prefer not to have the image now.
Okay,
I'm
well,
here.
I hope you recover soon.
Thank you, Michelle. Thank you.
Professor, thank you very much for joining us. And we were discussing a little bit of the adoption of the QDMTT in Brazil, and if were adopting it too early, if it was good policy or not. And of course, I was bringing some of the issues that you brought on your paper, regardless of adopting or not QDMTT, UTPR, and IRR. So we were debating a little bit of that and heating up to the discussion. So thank you for joining us. And Professor Tsui, I think everybody knows him by reputation. He's currently a professor of law at the University of British Columbia. very, very preeminent on talking about international tax issues, and especially with some very interesting views on Pillar 2 and its adoption. So, Professor Tsui, thank you for joining us, and hopefully we can get a grasp on how China is going to play out in this whole debate, and your view on the adoption process and the future of Pillar 2. The floor is yours.
Okay, fantastic. It's good to see all of you. Now, I just want to make sure, am I talking to Gustavo? Are you hosting?
Yes, this is Gustavo.
Okay,
I'm
hi
hosting.
Gustavo. Good to see your face. I've heard of you for a long time too. Okay, great. Thanks for this opportunity. I did prepare some slides. If I could be allowed to share slides, that would be very
Sure.
helpful.
Is it already? I think it's already allowed. If you could just try it.
Okay, great. Yeah, let me work on that. Hold on. Do share. Are you
Yeah,
able to
I think
see
I think
my?
it's coming through now.
Okay, that's great.
Yeah, we can.
Okay. And what are you seeing now? I think
We
wrong,
are
wrong
actually
setting, right?
not seeing. Yeah, I need to see your other screen.
Is this good?
There you go. There you
Okay,
go.
great. All right,
There we
thank you.
have it.
Um,
Professor Tsui, we are also we have enrolled students. It's 25 students. Most of them are here, and some of them are online. But we are also transmitting it because we had more than 100 people enrolled. We could not accept them all as students, but we did open for transmission. So there are more people seeing us than those that are on the call. Okay.
I see. Got it. Okay. That's great. Okay, thank you for letting me know. So let me start by saying that I'm based in Vancouver, Canada. I do work in an environment in North America where public and scholarly discussions of China in the last few years have become increasingly problematic. We now live in an age of geopolitical rivalry that's of a very intense sort. So all of us are influenced daily by media stories about how powerful countries like the US, China, the European Union, Russia, and others are doing to each other. It can be very tempting for us to draw on these media stories to fill in our areas of ignorance in some specialized topic, such as international taxation in China. Um, I just want to remind everybody, you all recognize this, whatever media outlets we follow, they're increasingly likely, they're more likely than ever before, to be biased, partial, and polarizing. That applies to all of the media that we follow ourselves. The casual narratives that distract us are increasingly unlikely to capture the complexity of the real world. So if you care about getting facts right, this is a very difficult environment we live in today. And so I say this because, the global minimum tax is a controversial topic. China is even more controversial. I can tell you that in the last couple of years, everything that I've read about China international taxation struck me as catering to fairly casual, superficial narratives and also missing basic facts. So I offer this preface in case you find what I say surprising or unsatisfying. I'm going to present 7 slides and leave plenty of time for question and answers. Uh, but you should be forewarned that what I prepared may not be what you expected. Okay. The first slide is this. How do we think about the adoption or non-adoption of Pillar 2 for any country? And that could be the US, that could be Canada, that could be China, that could be Brazil. My basic argument, the framework that I approach this topic with is I think because of Pillar 2's design, it is actually against the national interest for countries from which multinationals originate, which we call UPE countries, the countries that host the ultimate parent entity. It's irrational for these countries to participate in Pillar 2. Okay. So, if a country is acting in its own interest, they would not participate in Pillar Two. And if you take this perspective, and if you think that countries generally act in their self-interest, then if you see UPE country governments that do not participate in Pillar Two, no other additional explanation is needed. And what are the countries that are not participating in Pillar Two at this point? We could name most prominently US under Republican control, China, but we also have India and other countries. Okay, this is an important population of non-participating countries. But what's interesting to discuss, I think, but I'm convinced that for these countries, non-participation is something that you can easily see the reasons for, and no additional explanation is needed. By contrast, it is the UPE country governments that participate in Pillar Two, for example, the US under the Biden administration, the European Union, Canada, Japan, Australia, and others, that specific explanations are needed. Okay, I think there are interesting stories about why the US sponsored Pillar Two in 2021. There are interesting stories to be told about how EU came up with a EU-wide directive. And then there are more puzzling examples, possibly less interesting examples, explanations of why countries like Canada, Japan, and Australia are participating. I'd love to hear about your views about possible explanations. I'd love to hear about your stories of Brazil's decision. Let me just say that there are some banal explanations of why countries, governments may be participating in Pillar Two, and we'll leave them aside. There are always ill-informed politicians, so I can tell you that the Canadian federal government adopted a whole slew of obviously ill-informed tax policy within a single year, 2024, and they're widely agreed by specialists to be ill-informed policies. If you see things in that context, it's a little hard, the expectation that governments will adopt enlightened policies is substantially lowered in the last few years. There's also the fact that Pillar Two does offer a bonanza for the global tax profession. And by tax profession, I don't just mean tax accountants, tax lawyers providing professional services to taxpayers. I actually have in mind also tax bureaucrats, government officials who work for tax agencies, and even the tax directors of multinational companies whom the Pillar Two may adversely affect. It may still be in the interest of tax professionals to promote this global tax package that enhances the opportunity of professional services and also the importance of tax professionals. Okay, so why do I think that it's against the national self-interest of UPE countries to participate in Pillar Two? This is set out in this paper that I forwarded to Professor Vittori. It's called Strategic Incentives for Adopting the Global Minimum Tax. The summary of that article are 2 points. First, when the adoption of the income inclusion rule simply invites the adoption of the qualified domestic minimum tax in other countries in response, the UPE countries, the countries of multinational headquarters, would transfer large quantities of national wealth to countries hosting MNE subsidiaries. And this is against national self-interest. And so if you say that if it weren't for Pillar Two, widespread adoption of something like the QDMT would not happen around the world, then you can see why countries that host multinational headquarters should be quite hesitant to adopt Pillar Two because it encourages wide adoption of the QDMT. So I tend to think that this is a fairly obvious point, and some scholars agree with me it's a fairly obvious point, but my experience in the past year is that I spent quite a of time just explaining this first point to many practitioners, but also including other scholars. So I'm just going to put it out there. I'm happy to talk about it if you have questions about this claim. The second claim is more specialized. I argue in the paper that neither IIR nor QDMT adoption is a rational response to the UTPR. That is what has been branded as an enforcement tool under Pillar 2 to get countries to adopt the OIR, the QDMT, namely the UTPR, actually does not have the enforcement power that many attribute it to it. So in other words, if many countries adopt the UTPR, that may not be enough to move a country like the US or China to adopt Pillar 2. Okay. And so I'm happy to um, uh, leave that aside and elaborate if necessary. But here, if you believe in these arguments, if you believe that it's against the national self-interest of UPE countries to participate in Pillar 2, then we actually can make sense immediately why so many countries have not adopted Pillar 2. So I want to acknowledge that most Pillar 2 commentators, including other guest lecturers in this course, may not have paid attention to these arguments, may not have fully absorbed these arguments. So let me offer a simplified conceptual exercise just to get one part of the story across. Okay. I think this is invites you to look at Pillar 2 in a big picture fashion. Consider the following conceptual exercise. If the US or China or Brazil is concerned with profit shifting by its own multinational enterprises, it can strengthen its own rules for worldwide taxation to eliminate the benefits of profit shifting. And one example of this is the US GILTI rules. Okay, and so I take that as a starting point. Now, the multinationals in that country imposing very stringent worldwide profit taxation rules would not like this. And they would say that this kind of regime puts them at a competitive disadvantage relative to other countries' multinationals. Okay, we can understand this. Now, consider three possible responses by the government to this kind of business protest. A first response is to invite other UPE countries to jointly strengthen rules for worldwide taxation imposed on ultimate parent entities, on multinationals. Okay. Now, you have to remember multinationals come from a relatively small group of countries, countries like China, Brazil, the United States, EU. Most countries in the world do not produce very large multinationals. Okay. And so if you wanted this kind of collective action, you would not have an inclusive framework of 140 countries in the world. Instead, you would have a small group of countries. And here there's a question, in the age of geopolitics, do you invite just allies to join, or do you also include others, countries that are not allies? Okay. So I think something like this is quite understandable. It's what one might probably call the liberal international economic order. And that is an economic order that would not be too inclusive. Okay. Now consider the next response, which is not something that we talk about in the international tax sphere, but it's what happens in the real world. Okay. If multinationals from different countries are competing, and your multinationals are competing, that they're at a disadvantage compared to multinationals in another country, one possible kind of action for a government to do is actually to attack other countries' multinationals. Okay. Now, so far, this kind of attack has generally been disguised under national security grounds. And there's a huge debate about what national security amounts to. But attacks on other countries' multinationals at this point is not unheard of. And I list a few here that are related to China. Okay, and so you have the attack on Huawei, you have the attack on TikTok, you have attacks on EV solar panel and battery manufacturers from China. So this is, these first two options are fairly familiar to observers of foreign relations and international relations. The last one, the solution, is to invite other countries to tax one's own multinational enterprises more. Okay. Along with this, you might invite other countries to tax other countries' multinationals more as well. Okay. This is Pillar 2's unique approach. Now, if you take the perspective of the US, say, if I'm worried about my multinationals um, shifting profits too often, too much, and I want to deal with that, and I want to counter my business community's complaint about my stringent taxation, what do I do? I could do the first of these three choices, which is to invite other countries to join its strengthened rules. Or I can do something like, asking countries like Ireland and Singapore to tax my multinationals more. Okay. And as a result of which, my multinationals will not engage in too much profit shifting to Singapore and Ireland. That's a very strange way of solving this problem. But I would say that is Pillar Two's basic approach. It's what makes Pillar Two unique. Okay. Having looked at these three broad options, I think it shouldn't be too surprising if China and other countries are not too interested in any of these responses. Okay. These are simply the three standard options. The first two we're familiar with just from watching, reading about international relations, and the last one is familiar from Pillar Two. These are just not things that appeal to countries like China and other countries. Okay. Here, I want to be more specific. Let's think about how concerned China is about profit shifting by its own multinational companies. Here, a little bit of long-term memory would be helpful, and I use the term long-term memory ironically here because I'm asking us just to look at the past 20 years. Okay, there's so much revisionist history in connection with the global minimum tax that what is well known 20 years ago, 15 years ago are not remembered now. So I just want us to recall the following, and this is a few facts that are highlighted in this piece that I wrote for Tax Notes International in 2021. So this was published in July 2021 after actually it was written before the first OECD inclusive framework statement about two pillars was actually published. This was written after the early June announcement by the G7 for the global minimum tax. And it definitely was written before the QDMT and the UTPR, as we know them now, appeared in the OECD Pillar 2 model rules in November 2021. I highlight a few facts in this article. Just 20 years ago, in 2005, China's capital control regime prohibited unrepatriated foreign profit. And so Chinese multinationals, to the extent that there were some, most of which were state-owned back then, they were not allowed to leave their profit from foreign trades abroad. They have to bring them back right away. Okay. In 2008, a new corporate income tax legislation, the enterprise income tax law, was introduced. The primary effect of that legislation was to increase the taxation of foreign direct investment into China. Okay. This is a good illustration how integration into global markets may increase rather than decrease developing countries' capacity for taxing capital. Okay, and so this is an important phenomena from a scholarly perspective, and I provide links to some scholarly articles showing that China is not unique in this regard. It's a general trend. Because as of 2007, when the enterprise income tax law was drafted, there was still so little Chinese overseas investment. The provisions about taxing foreign profit were mostly copied from the tax laws of developed countries such as the United States. It's a combination of the United States and EU. Okay. Until recently, most successful Chinese multinational companies still realize most of their profits in China's domestic markets. Okay. And so this is a rapidly changing situation where, the situation 10 years ago may be different from the situation now. Now we know lots of very successful Chinese multinational enterprises. It may still be true that they realize most of their profits in China's domestic markets. That may change. Suppose Chinese battery, EV, solar panel manufacturers Chinese pharmaceutical companies decide not just to export, but actually to set up operations in places like Europe and Latin America. And that could be for a whole host of different reasons, right? Suppose they did that, they would have more foreign profits. That's not the case yet. Okay. So because of all this background, I think it's quite open to ask the question, how big a concern is profit shifting for China? Okay, I don't think there's a definite answer to that, but these suggestions, these facts suggest that the concern will not be as great as it is for the US government, for the Canadian government, or for European governments. And then finally, the last piece is that during the last 10 years or 13 years, when Chinese economy and Chinese multinationals have become very active, the main policy direction within domestic tax policy has been cutting taxes for businesses. This has been difficult, has raised challenges for the Chinese government's budget, especially for some national governments, but this is the general orientation. Okay. And so you can look at this and think, for a government with this kind of orientation, how interested are they in reducing profit shifting for Chinese multinationals? Domestic tax rates in China has actually been declining. Okay. And you can think about what are the incentives for profit shifting when domestic tax rates are actually dropping. In short, I would say that America's and Europe's tax policy problem may just not be China's tax policy problems, and it may not be other countries' tax policy problems. Okay, so this is the basic idea that we have to recognize when there's a claim that all countries have the same interest in reducing multinational profit shifting. They have the same policy urgency to increase their corporate tax rates. That kind of claim ignores very different tax systems and very different fiscal needs in different governments. Okay. Now, Canada may claim that it has the same policy orientation as the United States. That may or may not be true, but that's probably more likely to be true than a claim about China as having the same tax policy objectives as the United States. Here, I would point out that many stories we hear about the global tax deal are of extremely recent vintage and reflect specific political objectives rather than scholarly consensus. I've written in the last couple of years quite a bit about this. And so, for example, you can question how serious is multinational profit shifting. This is a topic of scholarly controversy, even in the US and in the EU. And I can give you citations about how scholars are debating this issue. You can ask how serious is the problem of international tax competition. Some people are happy to talk about tax competition regardless of the evidence, but if you look at the evidence, you might find that international tax competition is not something that's obviously emerging from the data. We can ask question, are countries cooperating to achieve something in international taxation? If so, what are cooperating to achieve? And common claims about how countries have always been cooperating. They agreed on the international tax paradigm in the early 20th century. This is a kind of claim that I feel that maybe students in non-OECD countries are especially likely to hear, because that's what is the authority for a Western international tax paradigm to inform, to instruct the rest of the world. One claim is that this agreement has been there for 100 years. Okay, I think all these things can be challenged. Okay, my final slide. So many of these things may not be what you expected. My final slide is why did China sign up for Pillar 2? If you thought that China was part of the creation of Pillar 2, if you take that fact as a given, you think the simple question is, why is there inaction from China? Here, I would say, let's look at the facts. First of all, where's the signature from 2021? I don't think any of you can locate it. We need to remember the easy basic fact that Pillar 2 suggests a common approach. Inclusive framework members are not required to adopt the globe rules, but if they choose to do so, they will implement and administer the rules in a way that is consistent with the outcomes provided for under Pillar 2, including in light of the model rules and guidance agreed to by the inclusive framework. And so I'm just quoting how the common approach is described. Inclusive framework members also accept the application of global rules applied by other IF members, including agreement as to a rule order and the application of any agreed safe harbors. Now, I want to ask you to think, what does it mean for a country to adopt the global rules, but to deliver inconsistent outcomes? How do we give it meaning to that idea? That's the first part of the sentence. I would say it's very hard to give it meaning to that idea. Okay. You adopt a set of rules that deliver a different set of outcomes. It would not be viewed as global rules. Okay. If we look at the second part of this description of the common approach, what does it mean for countries to accept the application of global rules, right? And so I see that later in this week or in the seminar, you have discussions about the legality under international law and under treaty law for different Pillar 2 provisions. Suppose that there are these conflicts. Does it mean that all these conflicts with existing international obligations were waived by a press release in October 2021 by 140 countries? That seems very unlikely, right? On the other hand, if there are no international legal conflicts, what does it mean for countries to accept other countries enacting some law, right? What is there to prevent other countries from adopting this law? So I think of the common approach as describing something that's tautological. It really doesn't have any content for agreement. And as a result for that, it doesn't really require any political commitment. For us to say that there was a political commitment is a euphemism. It's very hard to pin down what countries agreed to. And if you look at it that way, the idea that China signed up for something but is not doing anything becomes less of a puzzle. Okay, that's what I prepared. I'm happy to enter discussion and answer questions.
Great. Thank you very much, Professor Tsui. I have some, but of course, priority will be given to the students. So do you have any questions that you want to pose right now? Yeah. Can you make it be easier?
Hello, Professor Tsu. Are you hearing me?
Yes, I can hear you.
I believe you. Okay. So you're claiming that neither IRR and the KMDTT adoption is a rational response to TPR, right?
Yes.
Based on the argument that the extraterritoriality. However, let's imagine a situation where
Can you say that again? What do you mean based on extraterritoriality?
yeah, that I believe this is your argument that why OTPR adoption will not push to RRR and key MDTT. No,
I'm not sure what you mean by that.
no, I would point like that. Just imagine a situation when you have a big market like European and a country that has this market adopt OTPR. And so basically every company, every M&A has a subsidiary or a P in this country. Um, if if this country that has a big margin adopt OTPR, how can nobody else can adopt a KMDTT to protect themselves from this UTPR? That's my question.
Okay. I'm happy to address that question. Gustavo, should I do that?
Yeah, I would probably have a follow-up regarding this, but I think you can address it and then when we move forward.
Okay, so this really has to do with understanding Pillar 2 as opposed to understanding China. And so I'm gonna be sharing a slide. Can you see this? Okay, I'm just going to quickly go through the argument why the UTPR fails to enforce QDMT adoption by non-UPE countries. Okay, and so imagine that the EU enforces the UTPR, the safe harbor period is over. Now consider a low tax country, whether they should apply the QDMT to a multinational's local subsidiary in response to another country's, here the EU's adoption of the UTPR. Okay, and so let's just make things clear. There are several things we can think about. The multinational, they invest in the EU and they invest in this low tax country. Here, the low tax country is Z, EU is X. The project investment in these countries can either be making zero profit, they barely break even, or they generate positive profit. Okay, and so this is called marginal and inframarginal investments. Okay, if a multinational realizes negative profit in any country, it's going to exit. Okay, it doesn't make sense to continue to operate that operation. And then let's imagine that the multinational has other marginal investment opportunities in the rest of the world. Now, it's pretty clear that if the multinational's investment in the European Union, the UTPR imposing country, is a marginal project that barely breaks even, then levying the UTPR on this project will just make this project unravel. The multinational will simply exit this project, okay? In which case the UTPR is not going to be effective through the channel of this particular investment, okay? Now, let's consider another possibility. Suppose the project in the EU is inframarginal, it makes a positive project. Let's look at the project in the low tax country. If the low tax country, the project is marginal, only with a subsidy, only at low tax. If you increase the tax, the project is going to be a negative profit, and therefore the multinational will not invest. In that case, with the UTPR imposed, the multinational will no longer invest in this low tax in this project. Okay, because overall, the multinational is losing money by investing in this project. It's getting a subsidy from the low tax country, but it's being subject to the UTPR. It might as well go to other countries where they have break-even investment opportunities. Okay. So the result here is that if you look at four logical possibilities, one is this row is the investment in the UTPR country is marginal, in which case the UTPR is not going to be effective, in which case the other country should not introduce the QDMT. It doesn't do anything. In this one situation where the UTPR country holds an inframarginal investment, and the low tax countries holds a marginal investment, there's no reason to impose the QDMT either, because either way, the multinational is going to exit. Okay. And so the only remaining possibility is that both the UTPR country and the low tax country are hosting positive profit projects. Okay. What does that mean? That means that X or the EU could have taxed this multinational company more in this local project before. Okay, it didn't do that. The only reason that it can impose the UTPR is that there's profit left here that's not taxed. Okay. Also, the low tax country could have taxed this multinational company more without driving the project away. Okay. That's the only situation in which the UTPR can have some kind of effect. And here, the argument is that it's very strange for you to say that Z, the low tax country, is going to tax the multinational profit in its own territories only if X or the EU tax the positive profit in its own country at a higher rate. That's a very strange kind of reasoning. It doesn't reflect some kind of rationality. It doesn't reflect any kind of national income maximization behavior. That is the argument.
I see that Victor raised his hand, but I have a follow-up specifically regarding this. I understand the reasoning. Just two questions. The first one, with UTPR, if X imposes an UTPR on its own subsidiary and its own project, and it's marginal, I agree there will be a negative income, but I don't think with QDMTT that will be the case, right? Because if Z's project is marginal and Z has a QDMTT, you won't have a negative income result. You will just won't have top up. Am I missing something, or would that be
Okay,
the
yeah.
case?
Yeah, let me just explain this case. What we're saying is that suppose you have a investment in a low tax jurisdiction, and it's a marginal investment. That means if the tax rate is raised higher, it would no longer be a marginal investment. It will be negative after tax. Okay. And so the marginal investment is feasible only because the tax rate is not higher. The QDMT is going to raise the tax. That's one way of making the project infeasible.
But
Another way of making the project infeasible is for the QDMT country to do nothing, but the UTPR is imposed in another country. That makes this investment on the whole negative profit for the multinational. And so it's not going to invest in this country anymore.
but
So-
isn't this assuming that we're taxing more than the profit?
No. So let's just agree the basic idea. Suppose that you have an investment of $100 requiring 10% return. That's $10, right? Suppose that you have the investment is going to be feasible, generating $10 return only with $1 of subsidy. You can think of a low tax as a subsidy relative to higher tax. Okay, so if you remove that $1 of subsidy, or you can think about that as raising the tax by imposing a top-up tax, that project is no longer marginal. So this multinational company will go to other places in the world where they can generate a 10% return.
Gotcha. Perfect. Vitor?
I hope you can hear me well too, Professor. We're honored to have you.
We
Can
can
you all
barely
hear me well?
now it's better.
Let me change the mic.
It's working. Now it's good.
It's working. Okay, great. Just very briefly, Professor, I would like to make two questions. I see a bit of contradiction in what you exposed. At the beginning, you were saying that U.S., China, and some other countries have no interest in adopting Pillar 2 because they will lose tax revenues for other countries. But at the same time, you sort of deny the existence of international tax competition. Let me change my speaker here. Can you hear me well, Professor?
Sure. Yeah, I can still hear you. Yeah.
Okay, great. Yeah, I was asking first about what seems to me as a contradiction on your speech. You first said that U.S., China, and India are not interested in Pillar 2 because they'll lose tax revenues for other countries where subsidiaries of UP are located, and at the same time you sort of deny the existence of international tax competition, like attraction of businesses and incentives and everything. So I feel a bit of a paradox in that position. Like there's no problem to be solved. Like perhaps Action 1 or all these details that we see large multinationals doing are not something to be tackled. Of course, you said countries like U.S., China could strengthen their CFC rules, but I don't see that happening either, because it seems to be part of the economical policy of these countries to let companies spread themselves around the world and make profits abroad. And my second question is, isn't there also a sense of urgency from China's perspective, since we recently heard about the non-RE companies, non-resident entity companies in China. You certainly know the work by Noam Note and Jingi Wang, bringing details on how the largest Chinese multinationals operate. They can trickle the road to be considered non-resident. So isn't there also a sense of urgency, or the recognition that there is a problem in the international tax competition from Chinese perspective as well? I saw this as puzzling, that you sort of deny the urgency or the very existence of the problem.
Okay, there are several things to address. One is, putting China aside, the evaluation of whether countries generally have incentives to participate in Pillar Two. Let me see if I can get my slide up again. Here we go. So there is this basic claim that when IR adoption simply invites QDMT adoption in response, UPE countries transfer large quantities of national wealth to countries hosting multinational subsidiaries. This is against national interest. So I said that this is pretty simple and it doesn't need to be elaborated. Now I think I need to elaborate it. Look, countries should be maximizing their national income. I don't think governments maximize their tax revenue in their government objectives. They're always trying to maximize their national income. This is the supposition. Okay, national income is not the same as national revenue. If the U.S. government imposes stronger worldwide taxation on U.S. multinational companies, it doesn't increase national income at all. It simply moves national income from the accounts of the multinationals to the U.S. Treasury account. That's a transfer within the national income overall pot. Okay, and so it's crucial to say that here, what should governments be concerned about? It is when other countries, tax your multinational companies, which they would not otherwise do. When they tax your multinational companies that they would not otherwise have done, you lose national income. And this is why I say if QDMT adoption, white QDM adoption would not have happened without Pillar Two. I think that's not challenged by commentator on Pillar Two. That's something of extraordinary concern to countries like U.S. and China. Okay, so that's the answer to the first question. As to China, so the article from 2021 about Chinese international taxation talks about this phenomena of Chinese companies that are managed and controlled from mainland China, but that are deemed to be non-residents for Chinese tax purposes. That has not changed since 2008. That arrangement has been present since the legislation of the enterprise income tax. Okay, nothing has changed. And so over the course of the last 17 years, the Chinese government has seen this set of rules applying to a very different set of configurations, which is increasing overseas presence by Chinese multinationals. Okay, but throughout this process, it has been calculating, do we enforce the management control rule or not? Okay, it has a very gradual process of deciding how to apply that rule. And its consistent tendency is to say, it's okay, we're not going to deem these companies to be resident companies. Okay, and so there's no sudden discovery, there's no sudden finding. Oh, there's so many companies listed in Hong Kong and the New York Stock Exchange that are managed and controlled from China, but that are actually non-resident companies. The disclosures for that status, you can find that in 2009. Okay. So there's no sudden problem that the government has discovered and needs to fix now. And so I think that I don't know if that answers your question, but that's what this piece is trying to do. Let's remember what has happened. This is not a new phenomenon at all. Okay. And in terms of, my belief whether there's international tax competition, even if you believe that there's international tax competition, all of these arguments about whether it's rational or not to adopt Pillar 2 runs the same way. And so the argument about whether Pillar 2 is rational to adopt does not have to take a stance on international tax competition. In fact, the case for the irrationality of adopting IIR is more obvious if you assume there's international tax competition. If there is international tax competition, that means that your subsidiaries operating in different parts of the world will be subject to low tax because host countries are under pressure to lower their taxes. Okay, and therefore it's less likely for your multinationals to be subject to tax by foreign countries. Therefore, if these foreign countries suddenly started taxing your multinationals, you're losing a lot of national income that you would otherwise have kept. I hope
Thank you, Professor.
that's useful. Yeah.
Just a follow up, circling back to the other paper and the first part that says, well, there's no incentive for the IRR because if you adopt the IRR, the host countries would adopt a QDMTT, and then the transfer would be international transfer of income, and the IRR country would only marginally collect the profit shifting, but not the income. I fully agree with that, but what puzzles me a little bit is that you differentiate that from the regular worldwide taxation plus foreign tax credit. And in my view, that should be the norm with full worldwide taxation and foreign tax credit. So the capital export neutrality argument would go, well, you fully tax foreign income, and you give a tax credit up until the amount of your tax, okay, but you give a full tax credit for whatever the host country has taxed. The same incentive would exist for the host country to hike up their corporate income tax rates up until the limit of the average of the home country's worldwide income rate. So the issue is kind of the same, and this doesn't seem to be new because the economical norm would say that capital export neutrality wouldn't make sense. You should just give a deduction and not a foreign tax credit, because on the deduction you would be maximizing local income, under foreign tax credit you wouldn't be. But the world didn't stick with the deduction. It went through the foreign tax credit, and then it went what we see nowadays to territoriality 2.0 or something like that. So I the only thing is that I don't see that much of a difference on the response of host countries in a scenario where you have full worldwide taxation and foreign tax credit compared to the scenario where you have the IRR and the possibility of QDMTT. That is what puzzled me in your line of reasoning. So that's the first question that I wanted to ask. The second is, you said that governments are not revenue maximizers; they are global income, national income maximizers. They should be. I don't know if that's true with all governments. I think some governments are just tax revenue maximizers, and that would change the mindset overall. And finally, if everything that you put in your article holds, what explains the EU and other countries like Japan jumping to the UTPR plus IRR bandwagon?
Okay, that's great. All those are great questions. Let me try to answer them. And again, it's what I'm interested in. Perhaps we can come back to China after discussing these general international tax design questions. The first one is, you can say, how is the different design of Pillar 2, especially IRQDMT, different from ideal international tax design that involves worldwide taxation? The answer is this. We have not had real worldwide taxation of multinational profit ever for the last century. Okay. And for the United States, everyone acknowledges that it's not worldwide taxation. There's serious deferral. Okay. Um, and so when the US adopted GILTI, you can say that then people thought something has to be done about foreign tax credit system. We shouldn't be encouraging other governments to raise their taxes in response. Okay. And so you can use that concern to explain two things. That's why GILTI is blending tax from all across the world. Okay, and that has an effect of deterring countries from raising their tax rates. That's a very important effect that has been highlighted by, among other people, Chris Sancherico from UPenn Law School. There's also a 80% limited foreign tax credit. There's a 20% haircut. You can design all kinds of legal rules that deter other countries from raising their taxes to soak up the tax revenue potential for headquarter countries. The QDMT is a soak up tax, is designed to be a soak up tax, is understood to be a soak up tax. This is not classic design. This is not some system that any country prior to Pillar 2 thinking about designing worldwide taxation would consider. Okay. And so this is the QDMT is detrimental to countries' incentives to adopt OIR. If the QDMT wasn't there, if the US just approached its G7 allies to say, let's do something like the OIR, we'd be in a different world. Okay, so that's the answer to the first question. Second, are governments revenue maximizing or national income maximizing? Of course, in reality, they're probably neither. Okay, but I would say that if you look at any country's tax regime, international tax regime, you ask, can the government be raising more revenue? The answer is likely always yes, they can raise a lot more revenue. Okay, why are they not doing it? They're probably taking other things into consideration. Okay, that's why revenue maximization is a very poor way of modeling what countries actually do. Okay, and then the final question, I like how you pose it. If you say that acting out of national income maximization, UPE countries shouldn't be adopting Pillar 2, but why are we seeing so many countries adopting? That's what I highlighted at the beginning. I said, these countries require special explanations why they're adopting. And for the US, there's a very interesting story. For Canada, I think this story is more banal. But let me put it this way. I know that you will be hosting discussions about the legality of Pillar 2 and especially, let's say, the UTPR. Okay. Now, notice for us legal scholars, there are two very distinct questions. Is there some kind of legal problem, legal infirmity, or illegality to a particular rule? That's one kind of question. And we do that through doctrinal analysis. Okay. It's a completely different question. If this issue of illegality is brought to a court, what would the court do? Okay. And so the legality of something and the litigation outcome of something are two quite different things. Okay. So by the same logic, my article offers, you can say sort of a basic economic analysis of countries' incentives for adopting Pillar 2. And you think, from economic perspective, this should be predictive of what countries do. But what countries actually do, are they more likely to be paying attention to their national self-interest? Are they more likely to be paying attention to what the Trump administration does? Those are, completely separate questions. And so I agree that countries are not driven just by national income maximizing, but you think that when you're trying to predict the behavior of so many countries at once, that's probably the best hypothesis to go with.
Great. Thank you very much. Anybody else? Here, online? All right. I think we're on time. Professor Tsui, thank you very much for your presentation and for taking the time to be with us.
Thank you.
We fully appreciate the material you send, your papers, and we hope we can do this more often.
Okay, thank you for the invitation. It's good to talk
Thank
to you.
you. Thank
Bye.
you very much.
Bye.
Bye-bye. All right, so we have Marty in 10 minutes. I think we can do a 10-minute break, but we need to be back here at 19 sharp, okay?
Hello,
Hi.
hello.
Can you hear us well?
Yes, I can hear you.
Great. Martin, thank you for being here, especially I know it's 6 a.m. there, and so it's an extra effort for you to be here with us, and we really, really, really appreciate. Welcome, and
Thank you.
Professor Marning, I've already introduced you at the beginning of the class, but let me introduce you again. Professor Marning is a professor at the University of Liechtenstein, good friend of ours, goes to the observatorium, and we had the opportunity to discuss Pillar 2 at the observatorium last year, and it's a joy to have him here with us. Martin, Professor Schwede is online. He just had a surgery, so he's hiding his face because it's post-surgery Schwede's face, but he's online and he's with us, and he's definitely gonna enjoy and comment on your
Well,
presentation.
yes, Martin, you're very welcome. Martin came to Brazil last year for Congress, so he's feeling kind of me Brazilian already. He's very familiar here, and so I'm not surprised that he accepted again to cooperate with us. Thank you for this, Martin. And Martin is really enthusiastic of Pillar 2, so it's nice to hear him. So after Martin, we have just heard Wei Kui, who I would not qualify as enthusiast. So it's good to see the 2 points now.
So we just ended discussing with Professor Tsui. We discussed a lot on his paper, why would countries adopt an economical reasoning? And from his paper, nobody should adopt either the IR, the UTPR, nor the QDMTT. So the question was basically, so why did so many countries already jump into the bandwagon, not only with the QDMTT as a reaction, but also in Europe, not only in Europe, in Japan, with an IRR and UTPR. So we stopped with that question. And now we welcome you to talk about the global implementation, not only worldwide, but in highly developed countries and in European Union. So Professor Marning, the floor is yours. And thank you again for being with us.
Yeah, thank you very much indeed for having me. I hope you can hear me clearly, and I think I would like to share my presentation, but unfortunately this does not work as I can't see it. But maybe here, give me 1 second.
I think
That's
it's
a list
allowed
of
to share. You just hit the green button. Hopefully it's in your screen too.
this doesn't work, to be honest.
Worst case, I'll try to get it from here and I'll
That would
share
be
it.
fantastic.
All right.
I can also share it. I don't mind.
Or Niklas, you could do it maybe. That would be
Yeah,
fantastic.
then I will
Nicholas,
share it. Yeah.
if you have it, because I'll have to download, but it'll take a minute. But if you're gonna be for the whole thing, Nicholas, then you can share it.
Oh, that is fantastic.
All right.
Thank you very much.
Perfect. Thank you.
I will. Can you see it?
Yes,
Yes.
perfectly. So, oh well, we have copied something here on the front page. No worry. But to talk about the implementation of Globe and take Luis Eduardo's words of being enthusiastic of Globe, well, maybe it was kind of being enthusiastic of talking about a new tax system, in a way of you were all the way talking your life about tax systems, the one and the other, and there's a new one, and therefore there was a kind of an enthusiasm. If you go to the first slide, maybe we see just a very brief overview, not to bore you in length with that. We see how maybe the kind of the so-called level playing field can be addressed these days. So we see the giants on the left-hand side, and all these organizations of OECD, G20, G7 on the top, especially the Global Forum regarding transparency, and also the inclusive framework and the Forum on Harmful Tax Practice regarding BEPS and all these topics. And what we see is that these giants more or less introduced these organizations and forced to have these organizations worldwide. They are big contributors in so far. But on the other hand, they also, of course, challenged these institutions with their national policy, with their, let's say, overriding policy, following OECD standards or rather not following OECD standards. So I think that's one topic. And the other topic is that the Global South with the international tax system is just not happy, is just not in favor of, and therefore challenges. And we know all these developments on the way to a kind of a framework convention on international taxation. But I think it's important to have also this picture, and within this picture, one puzzle stone is the global minimum taxation. Having a look at the next slide, we then see that, for instance, for Liechtenstein, but also for Brazil and many other countries, of course, we are kind of price taker. So whatever is on the international tax agenda from the OECD, from whomever, we will take over that for the reason of being implemented economically on the globe, especially as a developed, highly developed country. So this means we need open access of markets and all these things. So therefore, it's no question to take over international tax standards, even if it's only a best practice, a recommendation, a common standard, and not only a minimum standard, and therefore pillar 2 comes into play. Next slide, please. And then we see what I was mentioning regarding the Global South. Forget about all the details you see, and maybe just have a look on the right-hand side, right on top, where you see countries with multinational headquarters. You see many countries with operational companies and with investment companies. That can be a finance company, an IP company, and many others like that. And we live in a time where we have introduced globally BEPS standards 1.0, and also all kinds of substance requirements that are addressed with regard to the different very detailed anti-abuse and DTC abuse and whatever clauses. And within that, we see, of course, kind of tax competition between these multinational headquarter countries and also within the investment companies and countries, and in between them. And the result of all this is that, of course, tax competition plays a major role, and therefore the idea of global minimum taxation has been developed, has been introduced. Next slide, please. So where we are today we are in a situation that we see they have in the center the national corporate income tax systems. This is the tax system of Switzerland, Brazil, Liechtenstein, Germany, you name it. On the right-hand side, we see kinds of tax exemptions that can be especially for charitable institutions, charitable foundations, for instance, but also for certain only administrative entities. This means entities that hold certain amounts of assets. In Asia, we would call it family offices. In Europe, that might be certain special companies, but their common characteristics is that they do not do any kind of economic activities, but rather administrative asset holding activities, if you call it even activities. So they are not under the radar of BEPS, for instance. They are not under the radar of the Forum on Harmful Tax Competition, and they are not under the radar of EU Code of Conduct and EU state aid rules. And this is not only charitable entities, but it's also these pure administrative entities, legal entities. On the left-hand side, of course, you see the new GLOBE corporate income tax system. And I think it's important to understand, next slide, please, that we have a full corporate income tax system insofar. And if we go one slide further, again, not going into the details, then we see the GLOBE tax system, and therefore maybe this was my enthusiasm. We see a full corporate income tax system with a tax base, very detailed, elaborated, with tax rates, the STTR 9% and the GLOBE 15%, and of course also a corporate income tax system. So we see a full corporate income tax system, which is a worldwide corporate income tax system. It's not a territorial tax system like Uruguay or Hong Kong or Singapore, just to name some of it on the globe, but a worldwide corporate income tax system. And of course, this is the new benchmark. And if we go one slide back, please, then we see that in this kind of basic example, of course, there is a parent, and that has an effective tax rate of 25%, so no problem, check. We see the companies in country B. These two, they have a blended effective tax rate of 15%, so no problem, check. But we see company C in country C that has an effective tax rate of only 7.5%. And here, let's say the implementation of GLOBE starts. What does it mean then? Well, the issue is that whatever company C in country C is doing, active business or so-called passive business, with this traditional distinction between active and passive income, it has to be taxed, let's say, under GLOBE, or it is possible to tax it under the common rules of GLOBE with 15%. The question only is, because this is a very comprehensive mechanism, it's a comprehensive tax system, these GLOBE rules. The question only is, who will tax these profits? And we don't distinguish, again, between passive and active profits. So it could be either company A in country A with an income inclusion rule, as you already learned, or it could be maybe the companies B in country B with the under-tax profits rule, or the country C insofar. And of course, highly developed, quite competitive countries, and just to name some, Singapore, Hong Kong, Liechtenstein, Ireland, Switzerland, you can add it, and so on. Of course, the idea, the political decision, if you want to say so, from the very beginning, when there was no QDMTT developed, was very clearly, I can assure you, that these profits of companies in country C, these countries decided in a way that they will be the countries who tax these profits, only they, and they will do whatever is needed to do so, because they will not allow any other countries, after the experience, especially also with CFC rules, very aggressive of other countries, that again other countries will tax these profits. And it was a kind of a whatever it takes momentum. And having said that, and with regard to that experience and decision, the QDMTT, a DMT, a kind of minimum tax, national or even a change in the corporate income tax system has been decided and gave the way through these QTMTT in a way of, yes, there will be this 15%, whomever will introduce an IIR and so on, a UTPR, we don't know it. But of course, we fear that there will something like that because we have seen all the CFC down the way, and therefore, very in a very early stage, and these countries and jurisdictions very early introduced globe, especially the QTMTT, in order to safeguard from the very beginning that these profits are taxed in country C by the C authorities, and by nobody else. And I think this is in a nutshell is quite crucial for the implementation in many countries, jurisdictions highly developed with a competitive tax system, doing economically quite well, as a basis of understanding. So having said that, we can maybe go further in the slide. Go to the next. Yes, please. Thank you. And we saw kind of trend, let's say. I mean, this is not too detailed, please, from the understanding, but this is kind of draw the picture. What can we see if we look at the many implementations we see? Of course, the whole story was boosted to start with in the middle, was boosted by the EU and the EU member states when the EU decided, for the good, for the bad. This is an own discussion, or we can go through that later on, to mandatorily implement more or less the globe rules, more or less, because there are certain transition rules up to the amount of ultimate parent entities that are within the respective EU member states. So that might be postponed for 5 years, that the implementation. But in principle, the EU decided, with its member states, Germany and France, playing a certain political role in proposing Pillar 1, especially Pillar 2, the EU decided to implement it mandatorily. So with that knowledge, and being the neighbors of EU member states like Switzerland and Liechtenstein, the decision was even more clear to introduce a QTMTT, because these countries will be in a kind of aggressive, they will have an income inclusion rule, and therefore, of course, other countries around the EU or within the EU, like Switzerland and Liechtenstein, being not EU member states, Liechtenstein being a member state of the European Economic Area, which is the internal market roughly, but not of the political EU Union, and Switzerland is not. So these countries were in a way forced to introduce at least their QTMTT. Having said that, of course, the basis is the globe rules, at least for non-EU member states, for non-EU countries, because the directive is not mandatory at all. And going ahead, we see kind of two ways for implementation. The one is having the corporate income tax act as they have in force, and then having a kind of a framework globe tax act. So this is the way, especially Liechtenstein and Switzerland went down the road. This means they have a kind of a framework act. For instance, the Liechtenstein Globe Tax Act is about 31 provisions, and half of it is regarding procedure and tax return and so on. So it's about 15 articles, more or less, that deal with the globe rules. What I want to say is that there is rather a big link. So what do they say in principle? And this is maybe a little bit simplified, but in principle, these rules say, well, the globe rules apply. And we introduce an IIR and we introduce a QTMTT, and in principle, we introduce a UTPR, although in Liechtenstein, the introduction and the application, better to say so, of the UTPR is postponed. But in principle, it's a huge link to the globe rules of the inclusive framework of the OECD. And the same, more or less, is the way Switzerland is dealing with it. Vice versa, EU member states, because of the EU directive, which is a kind of a copy of the globe model rules, but you never know if you do a copy if it is one by one or you have a slightly amendment. And if you go into the EU directive, you probably find differences to the globe model rules. Then all these detailed rules, so all the globe model rules are per se and are entirely introduced into very comprehensive Globe Tax Act. And if you have a look on these acts, they are roughly about 800 articles, being very detailed in this way. Well, how can we evaluate these different kinds of implementation? The the general link, more or less, to the globe rules have a kind of dynamic within these rules. Although the legislator would not tell us, well, we have a dynamic tax law referring to the OECD inclusive framework globe model rules, but in fact it is a kind of dynamic that we see here versus the EU directive being decided some years ago, and also the implementation is a more stable kind of implementation, and a very comprehensive, a very detailed one. And there might be more and more differences between the globe model rules, transition rules, safe harbor rules, and all that, and the implemented EU directive on globe. One other big topic, and this is quite interesting to see, is of course a rather European issue, is if we have a look on the scope, that we see that within the EU, but also within the EEA, which is roughly the internal market, having also fundamental freedoms and also the prohibition of state aid, Liechtenstein, Iceland, and Norway, that also insofar in both groups applying European law, not only the multinational enterprises with the respective turnover are covered within the scope, but also large-scale domestic group, in order of not to discriminate multinationals versus large-scale domestic group. So in these countries, also large-scale domestic group are covered. Having a look on Europe, this means that Liechtenstein is covering, for instance, these companies. Switzerland is not, because Switzerland is not a part of the EEA nor a part of the EU, and therefore here we see only multinationals covered. Yes, we can go maybe further on and see some specific aspects regarding the EU. As I mentioned, mandatory implementation of the globe rules in all EU member states, the IIR, the UTPR, whereas the introduction of the QTMTT is a possibility to do so. Then in principle, as we already mentioned, the EU follows the OECD rules in principle, and if we say in principle, there might be differences, although there shouldn't be differences. And on the right-hand side, then you see, well, left-hand side first, you see the inclusion of, as already mentioned, the large-scale domestic groups. On the right-hand side, you see the postponement until 2030 regarding the application of the globe rules, according to Article 50 of the EU directive. If there are countries, member states, EU member states, with less than 12 ultimate parent entities within their territory, so then they are not obliged to introduce the globe model rules and apply by 2024. Yeah, having said that, we may continue in the next slide, where you see a timeline, and this is from the focus, of course, 2024 introduction of the globe rules, especially the IIR 2025, the UTPR, and the QTMTT if member states decide to introduce the QTMTT, and of course also the postponement of rules in countries where we have less or equal as 12 ultimate parent entities. And if we go on the next slide, then we see a kind of a global map of the implementation of GLOBE so far currently, and our last check is from 19 February. So that is today, or from my perspective, already yesterday. And what we try to do in a kind of Standard and Poor's way is to classify all the countries, and we identified kind of an all plus, all in, all minus, maybe on hold and neutral minus status regarding the implementation of Pillar 2. And if I say we, then I include, of course, also Niklas Kaiser, who is joining us and me here, and I'm very grateful for that we follow this project quite for a while, which is also part of his PhD and beyond, and it's grateful, and I'm grateful that we do so. Well, all in plus is of course kind of EU member states, because they have the all in plus. They do all in, and they include not only the IIR and the UTPR, but also large scale domestic groups besides the multinational enterprises. What is interesting in so far, and this reminds me to the different tax systems we currently have. In the center, the corporate income tax system; on the left-hand side, the GLOBE system; and on the other side, the tax exemptions. We see that especially also countries like France, for instance, Germany, and many others, they shouldn't have to implement a QTMTT, but they all did. So this is quite interesting. So high tax countries, let's say, even trust themselves of being really a high tax country. Maybe a high tax country is not that high, and although we think about Germany, they're having an average corporate income tax rate, including trade tax, of about 30%, 25 to 30%, but they introduced the QDMTT. So also the German legislator is rather of the opinion that a company in Germany might be taxed below 15%. Otherwise, a QTMTT would not be necessary, would not make sense for the German legislator. But we see a kind of European focus in the all-in approach, and not only the GLOBE rules were developed and are developed in Europe, but in a way there is this nucleus of very strong implementation in Europe regarding GLOBE. Then when we can almost not see it, and maybe we go for 1 second to the next slide where we can see the European perspective. You see Switzerland especially, and you are not able to see, because we are so small, the country of Liechtenstein. And you see also that these two countries have implemented GLOBE, but we implemented GLOBE, especially the income inclusion rule, but not the undertax payments rule. Switzerland did not implement it. We did in Liechtenstein, but it's not applicable. And the reason regarding Switzerland is that, of course, Switzerland does not want to address US parent companies of the many Swiss subsidiary companies which are located in Switzerland. Every top US brand has an IP or sales or what have you company in Switzerland, to start with Coca-Cola and many others. Then we see, for instance, here also then these countries of all-in, that would be the UK. So in principle, they go an all-in approach, but they don't address, for instance, large-scale domestic groups, but only multinationals. So we see the first difference to EU member states, especially also with regard to the UK being a former EU member state. All in minus is then, and Nico can go back, please. All in minus is to address, in principle, only multinational enterprises and with one or two outs regarding the globe rules. And this is in regarding Switzerland, it was the IIR and the UTPR for 2024, and in 2025 it is the UTPR only. So Switzerland, for instance, has now implemented the QDMTT and the IIR um, regarding multinational enterprises, whereas in countries like EEA and also the UK and also Liechtenstein, we have introduced the IIR, the QDMTT regarding multinationals and also regarding large-scale domestic groups. Then we see quite a huge number of countries where we also have a kind of an all-in minus status. Very important, of course, Brazil, with also an example for a very curious, let's say, for us, but maybe not so curious if you look more on the details, with in principle a high corporate income tax burden, but of course also with many tax incentives for triggering certain investments, and also that could be discussed, Gustavo, with regard to the question of, well, why is a high-tax country introducing a QDMTT? Probably there are also some fears that the IIR of other countries try to catch Brazilian profits, and then the Brazilian idea is very much the same as the Swiss or the Liechtenstein idea, in a way of, well, Brazilian profits should be taxed in one country, and this is Brazil, and not anywhere else. However, we see many countries of kind of a maybe, and there might be not all countries classified with a maybe approach that use a kind of a maybe approach. And we see, for instance, Colombia, quite interesting, I think, with a kind of a tradition in minimum taxation. However, this minimum taxation has a similar role, limiting certain tax incentives, limiting to come via tax incentive in a tax burden that is too low for the political, from a political perspective, and nothing else is a kind of a QDMTT. However, the Colombian domestic minimum tax, of course, follows only Colombian rules and cannot be addressed to be a QDMTT by globe. Then we see quite important, I think, all the on-hold countries. So especially, and if you go a little bit further down, I think 2 slides more down, regarding the Asian Pacific region, then we see, of course, China here and India, and also further north Russia, that just don't say anything, to the best of our knowledge, whether they will implement GLOBE or not, or when, and so on and so on. So quite giants do not or have not made any comment on the implementation so far. They seem to be kind of neutral or immune insofar. Just being a little bit, or stay a little bit in Asia, and you see here on the one hand side the Middle East covering also here in being covered also in Asia. You see Qatar, Oman, the UAE quite active in so far, and we haven't seen them as active tax players in the last decades, but now they are on stage. In a very similar mechanism, that of course they attracted many companies with tax holidays within free zones, free tax zones also. And of course now they are in a very new kind of tax competition, and this is exactly what I tried to mention at the very beginning. So the UAE and Singapore and maybe Ireland and Switzerland are in a kind of a group, and there's a high kind of tax competition, as tax competition is not in the way between Germany and Singapore, or Brazil and Ireland. It's rather the tax competition, let's say, of countries within their kind of setup, I would say so. And we see further going to Asia Pacific, of course, also in Singapore, the introduction of globe rules, in Hong Kong, the introduction of globe rules, just taking these super important hubs in Asia Pacific, where many business investments are channeled through and to China and out of China, and Singapore in a more comprehensive Asian Pacific perspective. So maybe we go just back to the world map, um, and so we see quite with these kind of way globe rules work, and I think the most important is to the understanding of this is a global backstop mechanism. And with this boost of the EU member states having introduced and having announced to mandatorily introduce the globe rules, the level playing field, let's say, was rather open, and many developed countries with rather competitive tax burdens clearly between the 15%, some percentage points, or without any taxation because of tax holidays, free tax zones, and so on and so on. The level playing field was, of course, very open, that many countries not only thought about the implementation of global rules, but also, and I think this is kind of a global wave, we have seen, we still see, and we will see that many countries and jurisdictions think about amendments of their corporate income tax system, and in so far we are rather, let's say, on at the beginning or or already in of a huge wave of changing corporate income tax systems, of introduction, implementation of globe, and also, and this is the next step, and I think we talk on that next week, and also regarding how tax incentives should be designed this way, because this is then the very next step. If you lose, because of this floor of tax competition, if you lose kind of sovereignty of deciding on how certain investments and returns and profits out of investments should be taxed, then of course we talk on tax incentives, or we talk on incentives per se. Might it be in the future rather grants, or this or that, or direct payments instead of tax topics? Although we have a look at all that under or with a tax perspective, then you see, let's say, an even more dramatic development, and you see that globe is in a way a part of this dramatic development, but countries are really on stage thinking about the corporate income tax system, thinking about implementation of globe to make sure that they tax their profits, and also to think about their future policy with regard to the design of tax systems. We have some final slides with regard to the German-speaking countries, how the globe rules are implemented. We may have a more detailed discussion on that, or we just leave it with that. Both is fine. What you see is, at least for the Liechtenstein Swiss way, it's a kind of one by one implementation of the globe model rules. So having not any kind of many options or something like that, being very clear in so far, and for the Liechtenstein way, as we see here, it's most important to have the globe model rules implemented one by one, so that every other country, jurisdictions, the OECD, will see that these are the implemented globe rules. And therefore, for instance, the OECD already qualified the Liechtenstein IIR and QDMTT as being Q. So a QIIR, a QDMTT. So both are regarded as following the globe rules, and therefore as being regarded as qualified globe rules, and not as certain amended rules. Maybe just the last comment regarding some other, or not other, some EU member states and other countries. It's quite interesting that some use obviously the implementation of the globe rules to also implement some amendments of the globe model rules. Topics they did not introduce in their national corporate income tax system, but they introduce it in their in the globe, or with the implementation of the globe rules. For countries like Liechtenstein, this was never an option. It's far too complicated. You then start thinking about the differences between the globe model rules and your implemented globe model rules, and all these topics. And from our perspective, this was never an option. Not to confuse organizations like OECD and the inclusive framework, not to confuse companies within the country, but just to have this kind of plain vanilla globe introduction. This was and is the main focus, and will be so even if globe rules will change. Then of course these changes will be also implemented, or because of the huge reference to the OECD model rules, the OECD globe rules, these are, let's say, automatically implemented. Yes, well, with that, I would leave it with that, and I would be curious maybe about some Q&A, and some further questions, whatever is on your agenda. And first of all, I thank you very much for having us, and for listening to our some topics and issues we try to raise here. Thank you very much.
Thank you very much, Marty. This was great, very informative, and I have a couple of things that I want to raise, but of course, before that, let's see what the students are thinking, and if somebody has any question, could be online or here. Right. I'll jump in one, and I'm sure they'll take from there. Well, first you've put and you asked why did Brazil adopt, since it's at least on a statutory rate view, it's a high tax country, and yeah, the rationale is exactly the one you said. At least the rationale the government has sent to the public. We are leaving money on the table, and we might have some businesses that do have effective tax rate lower than 15%. And if we don't adopt a QDMTT, we're leaving money for other countries to tax what we should have been taxing. So it's the basic rationale of the QDMTT adoption, taking into account that everybody else is adopting either an IRR or an UTPR. So the only way to actually make this rationale work is if we take the premise that this thing is going to be taxed elsewhere because somebody else is going to get it either through IRR or through an UTPR, which may be true or may not be true. Of course, the European Union adopting full IRR and UTPR makes the case much, much more strong for us to adopting a QDMTT. But on the other hand, when you look at what's happening now in the US, and if you look at the China position, we're not so sure that we've done it in the proper moment. The second thing is we know the drivers for effective tax rate being lower than 15% in certain industries, and it's already being mapped that the second step is to transform the tax incentives into some kind of qualified refundable tax credit. And that is something that we'll discuss next week, but that is on the roadmap. And that is a weird thing. We'll discuss if that's a loophole of the globe or not, and if that is the rationale that most QDMTT countries, exclusively QDMTT countries, are going to take or not. So those are the two main things that we've done. But what I want to get into with you is the adoption process and the legislative choices that you mentioned in Luxembourg, in Liechtenstein, and in the European directive, and I'll go into the Brazilian choice, which is probably a hybrid between both of them. So we didn't do it just making a reference to the mother rules and leaving it at that. There is a law which deals with quite a lot, but the way we've done it is there is a law which deals with the main rules, but we do have a delegation to regulations. And the law particularly says, well, the regulations will keep this thing updated with the commentaries and the AGs and everything that is done in the inclusive framework. And of course, that hybrid is a little bit weird because at the one hand, they were trying to obey our legality rule, saying that, well, everything that needs to be in law is in law passed by Congress. So we're not taxing without having a law allowing us for us to tax and so on and so forth. But on the other hand, the delegation kind of takes away from it because you know that if one AG changes a safe harbor as Chapter 8 of the Mother Rules allow for safe harbors to be changed, everything can change. And a person that was once a taxpayer can not be anymore, or vice versa. A person that was excluded can be included. So, from a legality perspective, it's kind of a band-aid solution. It's not a full delegation to the OECD, all right, but it's a full delegation. It's not a full delegation to the regulations, but you delegate enough to the regulations to turn this thing on and off whenever it wants. And the regulations, the law says that the regulations has to bound to whatever the OECD and inclusive framework is doing. So it's weird from a legality perspective. And what I wanted to ask you about, if it, in Liechtenstein you do have strong legality rules that would make the way that you have adopted challengeable in courts or not? So that's the first question. The second one is looking at the European solution, which is to freeze everything in a directive. And the risk they take is the risk that our authorities didn't want to take, to freeze this thing and risk losing the stamp of being full Pillar 2 compliant, especially when you're exclusively looking at the QDMTT and you want it to be full Pillar 2 compliant, especially for the calculation method and how the SBIE plays out on the calculation, and of course for a safe harbor for the UP not having to reapply the whole thing. So we do understand why they did it that way here in Brazil. And what I fear is that in Europe, you might run into that at a certain point. And I don't know, in my mind, at least as far as I know, it's not that easy to update a directive. So how frozen is it in Europe, and is that something that worries European countries or not? Because QDMTT might not be the main thing there, and that worry is not that much of a worry. So those are topics that I wanted to explore with you.
Yeah, thank you very, very much for your I think very important question, and it goes directly, of course, into one of the most important topics. Well, starting maybe with the position of Liechtenstein, you're totally right. There's a kind of huge possibilities and requirements also for the legislator to address, as Liechtenstein, for instance, has a constitutional court, and you could bring up, of course, all these questions you raised to the constitutional court. That's one part. On the other side, I think. And we have seen it in a way years, decades, if you say so, before, with regard to international accounting standards, where there was from one to the other day, something like that, a reference to the International Accounting Standards Board, which is everything, but everything as a part of, let's say, the legislator of a certain country. You might compare it to the inclusive framework, to the OECD as an organization developing this. You might, but just having that picture. And I think what we talk about here is a kind of political law, and so what counts, especially for countries who have not, how to say, who have not thought about these rules, who have not introduced these rules. It was not the idea of such rules of these countries. However, they take it very serious, like Switzerland and Liechtenstein, that this is the new standard, and there's a kind of pragmatism in a way of, yes, if we go the road down the road, then we go down the road. We do not say we implement it, but we don't. We do not do amendments. We do not do this or that. If there is a yes, there is a yes. And having said that, for instance, the way of Switzerland was kind of an interesting one, addressing exactly what you mentioned. And what they did is they put the model rules, or they put the reference to the implementation of Globe, and therefore also the model rules. They put it into the constitution, and there was a referendum by the people, and if people put something into the constitution, it's constitutional law, and there is no constitutional court in Switzerland, and therefore you cannot challenge it, you cannot address it. So they made it kind of waterproof. And this is also the case in Liechtenstein. So how can we do it in a waterproof way? And if we follow this kind of international development, and have, and of course, as I mentioned at the beginning, the law and the explanation does not state, well, we have a dynamic reference. But if you think twice about it, then at the very end, it is a dynamic reference, and it is exactly not a dynamic reference or implementation or the like within the EU, as the EU is, as you exactly said, a freezed-in version of the globe rules. And um, having said that, the constitutional court would in Liechtenstein would probably, as long as there is a kind of a following of these international rules, whatever is international rules, but these kind of agreed setup, the constitutional court would not challenge these, and the implementation, in a way of that these international rules, if Liechtenstein decides to do so, then on a one-by-one basis, have to be respected. Um, Very different, of course, in the EU, and we are all curious to see how they do it. Niklas and I had a little bit look on one and the other countries, and we see, of course, kind of, let's say, more dogmatic, not dogmatic implementation. Germany could be named in that respect, and we see kind of more, let's call it, pragmatic approach, like Austria, and others, where we see a rather the following to the model rules than too strict to the EU directive. And of course, as everything has to be applied and so on, um, there's currently, let's say, not much room for any kind of challenging by courts and so on. Although we see the Belgium development, and so on. And yes, there could be, of course, courts, that prevent the application of these rules. And what does it mean then for countries if rules cannot be applied? Do they might have then a topic with the European Commission, and the European Court of Justice is ruling on them, because for then the non-implementation, the non-application, of a EU mandatory directive, I think this is a kind of an open floor, or an open topic. But I think very important is to realize that we talk of a kind of political law, and with that force, of course, countries, and of course, the Switzerland and Liechtenstein, they feel forced, to introduce so. But on the other side, with that feeling of being forced to implement it, then there's a decision: yes, no. do we go with that? And usually these countries go with that because they haven't developed the rules, they cannot stop the rules. The only thing is they have to apply the rules in order to be a part of the game, or in order to be still a part of the level playing field. And therefore, the focus is not so much, let's say, on constitutional issues and challenges, but rather following it and implementing it and being on the level of being regarded as Q. So in the very end, everything has to be Q qualified, qualified refundable tax credit, qualified domestic minimum tax. So we could also call Globe Q, like in the James Bond movies. But that's maybe another story.
Thank you, Martin. Anybody else has a follow up? We have 1 minute. All right. So, Martin, thank you very much again for being with us and for giving us this great presentation. I know it's super early there, and thank you for giving your time. And thank Nicholas too for helping with this. And see you next week.
Yes,
Thanks a
next week from Doha, we both. Niklas is in Liechtenstein, me in Hong Kong these hours, and then next week we will be both in Doha, in Qatar. Also curious to see how the development with Globe Rules is going on there, and would be great for us to join you again. Thank you very much, Gustavo. Thank you very much, Luis.
Thank you,
Maybe
Martin. Thank you very
on the
much.
phone. Thank you so much. Take care, Luis, and
Next time I shall be present there.
yes, of course. Love to see you.
Bye.
Thank you.
Bye
Have a
bye.
great
Take
day.
care. Bye bye. Thank you very much.
Bye
Bye bye.
bye.
Thank you very much also from my side. Thank you. Goodbye.
Thank you again, Niklas, for joining.
Sure, it was a
Thank
pleasure.
you so much. Thank you so much.
Have a
Bye.
good start into the day, and I wish you a good night.
Thank you.
All right.
Thank you.
Thank you, guys.
Good night, good evening, good morning, wherever you are.
Everything.
This is a global thing, you know. This is
Yeah,
a global
yeah.
thing.
Yeah. And this is being transmitted, so anyone can access it anywhere they want. So this is
Absolutely.
really a global thing.
Absolutely.